And welcome to Prescribing Prosperity with your hosts, John and Alex Soutsos. Gentlemen, how are you?
Good, Bill. Thank you. How are you?
Good, thank you. Good, Alex?
I'm doing well, thanks, Bill. How are you?
I'm good, and I'm eager to continue this conversation. But John, you mentioned navigating market corrections and bear markets and how investors can deal with it and how fund managers can help you deal with it. And you talked about the fact that your management has been quite good, and I would, in terms of navigating this market and limiting the harm. And I'd like for you to expand on that a little bit, if you would, please.
Thanks, Bill. So our model is a lot more nimble and flexible than institutional portfolio managers. Mm-hmm. So when I say institutional, what I mean by that are the large ETFs, whether they be in Canada or the United States, and the very large mutual funds. So just as an illustration, in the US, and just to be clear, even within Canada, some of these US models that I'm going to discuss are actually being used as sub-advisors for Canadian US equity funds. And our largest bank here in Canada, our RBC, also manages a large private equity US stock fund, and its performance is very similar to some of these institutional money managers, which I will discuss momentarily in terms of what's been going on so far this year. So very quickly, on a year-to-date basis, the U.S. market is down in U.S. dollar terms as of the end of last week, about 10%. Our core model is down 6.3. Now, the interesting thing is that the beta, which is a sensitivity metric to volatility relative to the stock market index, is at 0.63. So it stands to reason that we've only declined 63% of the market's decline. And that's on a year-to-date basis. But what has happened since the beginning of the year, because we started off the year quite strong, the market went up the first 6 weeks. Our portfolio went up even more than the market did in the first 6 weeks. But as we all know, the market peaked in mid-February, the US dollar peaked in mid-January. And since that time, we've had a correction in both the US dollar and a correction in the US stock market. So I've been actively repositioning the portfolio throughout this period, beginning with late February and right up until the present. I've been repositioning the portfolio to change the exposure and allocate more toward defensive sectors that include areas like insurance and consumer staples and some healthcare companies. Not United Healthcare, which took a beating last week. So that's part of the reason why we've done so well. So from the beginning of the year, we're only down, as I said, 63% of what the U.S. market is down. But if you look at some of the very large U.S. mutual funds, and like I said, you would have an equivalent experience, but if you were to own, for example, the RBC U.S. equity portfolio in their private client model, as well as TD Bank, BMO's accounts, etc. So these are all performing similarly. So the largest broad-based U.S. stock mutual fund in the United States is the Fidelity Contra Fund, and that's down 9.1%. The top performing U.S. equity fund over the last decade, when I say U.S. equity fund, I'm talking about broadly diversified, but growth-oriented, would be the Fidelity Blue Chip Growth, and it's down 19.25% on a year-to-date basis. Marsico Focus, which is another well-known growth manager in the U.S., is down 14% year-to-date. By the way, all this data is expressed in U.S. dollars. And Brown Advisory, which is a highly respected U.S. firm, is down 9.3% on a year-to-date basis. So what's interesting is, back to the Fidelity Blue Chip Growth Fund for a second, it was the top performing diversified U.S. growth fund over the last decade for the period ending January 31, 2025. But as we can see on a year-to-date basis, it's really tanked. So this speaks to the fact that from an investment perspective, when you're chasing top performance, by default, you're going to have exposure to more high beta stocks. What I mean by beta, of course, is sensitivity to the stock market. So a high beta stock would be a stock that has a beta above 1. So when the S&P moves plus or minus 1%, the high beta stock would move plus or minus 1.2 or 1.5. And that's what we mean by beta. And so if you're looking for high performance, you will tend to gravitate toward those high beta investments, whether they are in the form of a mutual fund or an ETF, but then you pay the price when you experience market corrections. So unlike these institutionalized investment portfolios, which are quite common throughout the US for 401k plans and in Canada for RRSPs or registered retirement income funds, we are far more active throughout the market cycle. And so just for example, in the last month, so as we know, the quote-unquote Liberation Day, which began April 2nd in the U.S., that caused a big additional tariff scare. Markets have dropped I shouldn't say quite significant. They've gone down further. The U.S. market, as measured by the S&P 500 index, is down 6.7% from essentially 1 month ago, 30 days ago. And our core portfolio is essentially flat. It's only down 0.5%. And we have 4 different all equity investment models, and each one of them are either flat or at worst one of our ETF models is down 1.9%. But our core portfolio is down only 0.5%. So compared to minus 6.7, I think we're doing significantly better. And by contrast, all of these high beta, highly acclaimed mutual funds and ETFs that are available in the US and in Canada, they're all down anywhere from 7 to 10% over the last 1 month. So our methodology is very active. You have to be nimble. You have to be prepared to move on to other stocks. You can't be emotionally attached to companies. The other thing we do that's different is, aside from just investing in relatively strong companies when markets change directions, we also make sure these companies have strong fundamentals. So let's take the consumer staples sector, for example, which is all defensive companies. Mm-hmm. Many of them have held up very well during the first quarter this year and in the last month. However, the vast majority of these stocks do not have strong fundamentals. So as soon as the fear lifts, and it will eventually lift, a lot of these consumer staple stocks are going to go in the other direction very rapidly, whereas the few consumer staples that have strong fundamentals will hold up much better. And so the companies I'm rotating into are not just have favorable trends right now and favorable relative strength. They're also strong in terms of their fundamentals. And that way, we're not going to be stuck in a position where we have to liquidate quickly because these things are going to tank because they've been overbought. Yeah. So that just brings to light some of our methodology and processes. The other thing that's really important right now is central bank interest rates around the world have been coming down rapidly in the European Union. And in Canada, we've had 7 interest rate cuts over the last 12 months. But in some other jurisdictions like the UK, Australia, and the US, we've had far fewer rate cuts. Yet there's if you look at Q1 GDP growth, Canada right now on a nominal basis looks like it's looking reasonably strong, but we know in Canada a lot of the GDP growth is being fueled by an influx of a population by immigration. So on a per capita basis, our economic growth or quote unquote growth is quite weak, and whereas in the European Union, their economic growth is pathetic. They're at 0.8 in terms of GDP growth for Q1. Now, interestingly, if you scan across the world at central bank interest rates, the Federal Reserve in the U.S. is in the 4.25, 4.5 range. Canada and the EU are in the 2 range. Canada's 2.75, European banks at 2.25. Bank of England and the Bank of Australia are both above 4%, similar to the U.S. But growth in those other jurisdictions is also not very good. So inevitably, we need interest rates to come down. Inflation in the U.S. has come down significantly. The official CPI figure is overstating the inflation rate. True inflation, which is a far more robust inflation calculation in the U.S., is showing an inflation rate of 1.3, 1.4%, which means that the central bank rate, which controls 90-day interest rates, is nearly 3 percentage points higher. So that leaves us a gap of at least 1 full percentage point to match historical real interest rates in the U.S. of 2%. And if in fact the U.S. economy is slowing, as is the narrative in some parts of the media, then the central bank needs to get ahead of the curve and drop rates even further than 1 full percent, perhaps by 2%. And I think that's where the discussion has been happening over the last week between the current U.S. administration and the central bank, which has been holding rates steady. The U.S. administration is looking for the central bank to cut rates further because if everyone believes the tariffs are slowing down the economy, then you really need the interest rate relief. So, the truth of the matter is the Fed historically is, and especially this Fed, has been behind the curve through both the period leading into the inflation and the period during the inflation and post-inflation. The Fed has demonstrated they're perpetually behind the curve, and that creates problems. So you need the Fed to get ahead of things, and they need to cut rates aggressively right now. And I think they might resist in the short term, but inevitably, I think you're going to see some dramatic rate cuts. And when those happen, I think you're going to see the market rally strongly, whether that begins in Q2 or Q3 or Q4, more than likely Q3. But that's the current state of the economy. That's how we've been handling it in our model portfolios, and it's helping our clients sleep a little bit better, knowing that they're holding up significantly better.
Yeah, that is interesting. And for anybody who's listening to this who wants to reach out to John or Alex and talk about this particular aspect of their money management and the portfolio management, the contact information's in the show notes. And I would encourage you to look there afterwards, or just wait till the end of this podcast, and Alex will give it to you. But John and Alex, what's interesting to me is, because this is an area which is sensitive to me, is with the markets being like they've been in terms of just being extraordinarily volatile and really difficult to ride. I mean, it's just like going to an amusement park and getting on a roller coaster, except, the roller coaster is programmed not to come off the rails. And it's not that case necessarily with the markets. So it becomes really sensitive in terms of people who are thinking about retiring and planning to retire, or people who are in fact already retired. So I'm wondering, guys, if you could talk about a little bit in terms of the impact on pension planning and just get into that whole area a little bit for us. I don't know who wants to take that observation of mine, but whoever.
Absolutely. So I think the best place to start, Bill, would be the RRSP program, which is the most well-known retirement savings vehicle that is available to people in Canada. Now, obviously, given that our market our focus is generally on medical professionals, we tend to market largely to them, although not exclusively. We will touch on some of the other options that are available to physicians, but specifically for the broad population, the RRSP, or Registered Retirement Savings Plan, provides them with the most basic and somewhat robust vehicle for saving for their retirement planning. Now, the contribution limit is flexible. It varies on a year-to-year basis. It's more or less generally indexed to inflation. So on an annual basis, you're looking at about $32,000 in today's money. $32,490 is the exact number. Over the course of your career, that means you're going to contribute a maximum of about just under $1 million, about $975,000. Your maximum benefit is basically unlimited. So the nice thing about the RSP program is there's no defined cap on what you can actually take out once you convert it into an income fund in retirement, a RIF, a Registered Retirement Income Fund. So depending on how big you're able to grow your RRSP, that will determine how much money you can take out from your RIF. Now, a RIF has a prescribed minimum, and that amount starts at about 5% once you reach the age of 72 years old. But assuming people want to withdraw more than the minimum, they absolutely can. Or if they want their minimum to be higher, if they want to receive a larger amount because they want to maintain a higher standard of living in retirement, the RRSP is probably one of the best vehicles because it does not provide a cap on how much money you can actually withdraw in retirement. There are some rules with regards to the RRSP. You get a tax deduction on the way in. So whenever you make a contribution, you obviously get an offsetting deduction from your income tax. So let's say, for argument's sake, that you were earning $100,000 and you contributed $30,000 to your RRSP this year. That means your taxable income is only $70,000. That's the entire purpose of the RRSP program, is you are writing down your taxable income, so that way you're paying less taxes now when you're earning more. And then when you withdraw it, over the time that it's invested, it's tax-free growth. And then by the time you withdraw it in retirement, you're going to be taxed at a lower rate because, generally speaking, your income in retirement tends to be lower than your income during your peak earning years. And that's one of the big benefits of the RRSP program. In terms of its portability, it can be transported between institutions fairly easily. There's no limitations there. And from an estate planning, tax-free. And from an estate planning perspective, it's a modestly favorable estate planning situation. You have a free spousal rollover, or if you have a disabled child, you can roll it over tax-free to your disabled child. Otherwise, once the final spouse passes, there's a full deemed disposition upon death. And at that point, it would be taxed as part of the final tax return of the estate of the last surviving spouse. From there, we start to get into more of the traditional pension options. So, Dad, you want to talk about Medicus?
Sure. So with respect to Medicus, there's an 18% contribution limit with an income cap of $187,833, which allows for a $33,810 contribution for tax year 2025, which is a little bit higher, roughly $1,000 higher than your RRSP contribution. The difference here is that when you contribute to the Medicus pension plan, by the way, Medicus is a grouped pension plan, and it's sponsored through the Medical Association. Your medical corporation makes the contribution to the Medicus pension plan, and the medical corporation receives the tax deduction. So if you calculate a 30-year career, your approximate lifetime contribution is going to be just over $1 million, whereas the RSP is just under $1 million. And your maximum benefit that accrues at age 65, and this is different from the RSP where there is no maximum benefit, but with the Medicus program, because it's a pension plan, your maximum benefit is 2% of the capped pensionable earnings for every year in the plan. So essentially, in this particular year, 2025, your current lifetime maximum is $137,020. And that gives you a nice contrast with an RRSP in terms of what happens after your lifetime. Well, let's go back to portability. You can, this plan is portable. It can go in a commuted fashion into a locked-in RRSP, or it can go directly into another pension plan. And there are some additional benefits in terms of estate planning and intergenerational wealth transfer that are different than the way they would work with a traditional RRSP, and that would be the cumulative benefit upon the death of the primary annuitant is paid to the spouse or beneficiaries. Post-retirement, if you die within 10 years, your spouse or beneficiaries will continue to receiving the income for the duration of the 10 years. However, if you pass away after 10 years, how much is left over depends on the form of the pension plan, and your spouse may get a reduced amount. So there's some intricate details that are going to depend on individual circumstances.
That's the Medicus plan. So the Medicus income that you're if you're using today's dollars, I don't know if you mentioned this, but the income that you're receiving in retirement is capped at $137,000.
Yeah.
So that's the physical or the actual dollar amount. So, as you mentioned, and as I mentioned before, that there's a benefit of having the RSP program, and that you're unlimited in the amount of income that you can receive. But in the Medicus plan, it is capped. So some people like the guarantee. They like knowing exactly what they're going to take home on a month-to-month basis or on an annual basis, and that's fine. For those people, a pension plan like that exists. And if you're somebody who wants to take on more risk, somebody who wants to have a higher income in retirement, then the RSP provides you with an option there. And there's no right or wrong answer. It's all just about trade-offs.
Yeah.
So with that said, we can also discuss HOOPP. And HOOPP is again, another more traditional pension plan. The HOOPP plan, which is the Healthcare of Ontario Pension Plan, was only until recently available exclusively to non-physicians who were medical professionals. It is since January of this year being made available to physicians as well. Now, the HOOPP pension, in terms of the contributions, work very similarly to that of the Medicus plan, because it is a defined benefit pension plan. So the physician has to contribute about 18% of their earnings, and they have to take that money as a T4 income as opposed to paying it out as dividends in order for them to contribute into the HOOPP pension plan. And then in a similar fashion, it calculates what the defined benefit would be in retirement. So for the average doctor who retires at age 65, it would be approximately $155,000, depending on how long and for how much they were contributing on an annual basis into the HOOPP pension plan.
I was just going to say the maximum contribution room for this year is $33,810,
Right.
which is very similar to the Medicus pension, and a little bit higher than traditional RSP. And the contribution limit over a 30-year career is similar to the Medicus at just over $1 million.
Right. When you talk about the tax and withdrawal side of things, it is the exact same. Anytime you're going to be working in one of these pension plans, or if you're working in even just a RIF or RSP, whenever you take money out, obviously it's going to be taxed fully as income, and so there's no real tax benefit to the withdrawal side of things. On the contribution side, there is deductions to your income whenever you're making contributions, because it is a registered plan. It does grow tax-free in the time that it's invested. But as we mentioned before, the fact that money then comes out as a defined benefit caps your upside. Portability is a little bit more limited. Similar to the Medicus plan, you can transfer the commuted value to another locked-in plan as long as it's transferred before the age of 55. So that means that the money is not able to be accessed until a prescribed point in time. And then from an estate and intergenerational wealth planning standpoint, it really depends on the time that you pass away in terms of how those benefits are going to be paid out. So there are some survivor benefits similar to the Medicus plan. If you pass away within a certain amount of time from starting to receive your pension benefit, that will still be paid off to your spouse for as long as they're alive. And then once they pass away, that's it. But for the most part, it is a little bit more of a restrictive pension plan compared to the RSPs, where the RSP, the full benefit of your assets gets transferred into the next generation, less the tax that's paid upon the death of the final spouse. When it comes to the HOOPP plan, once the final spouse passes away, that's more like, depending on how quickly they pass away, again, there's a lot of vagaries and nuance to these pension plans, and so it won't interest anybody to go into the full detail about it. But suffice it to say, depending on how quickly the surviving spouse passes away and what benefit they're receiving at the time that they pass away, the majority of the assets are going to remain within the pension to then provide cash flow for the other members of the pension. So your beneficiaries, your estate, will not necessarily benefit from the full value of the contributions that you've made to the HOOPP pension plan.
I think that's a very important point and a very distinguishing feature between the HOOPP plan and perhaps Medicus and the RSP, is the fact that any excess accumulation of wealth in the plan accrues back to the pool, not to the contributor or to the contributor's family. And so for that reason, we're not a big fan of the HOOPP program.
No. What ends up happening is you're, for lack of a better term, subsidizing the other members of the pension plan, specifically the the members, the generations that are going to come after you. And so, you've paid in your dues into the pension plan, but then by the time you actually get down to actually receiving the benefits, depending on how quickly or how long it takes for you to pass away in retirement, as we mentioned, your family and your beneficiaries likely won't see the true benefit of all the money and the hard-earned assets that you put into the plan itself. So again, it's a matter of trade-offs. Do you want guaranteed income? Are you willing to live with the fact that you're going to maybe pass along less to the next generation of your family? There's no right or wrong answer. It's just it's a matter of preference whenever people make that decision. So in terms of a more efficient method for transferring wealth between generations, Dad, do you want to talk about the IPPs?
Yeah, so the IPP is the individual pension plan. It's available to not only medical professionals, it's available to any small business owner in Canada. And essentially, you're registering a pension plan for you as an individual. And one of the strengths of the IPP is the fact that you can combine the benefits of the RRSP, in that you can accumulate a significant amount of money without necessarily a cap. But the other huge benefit is you can, as long as you're employing a family member, and it can be your child, or when I say child, I mean adult child, or it can be some other family member, a nephew, niece, could be a grandchild, it could be any family member. So as long as they're working for your company and you can provide a T4 slip, the benefit of the plan can continue paying out. So the plan basically in that scenario is never wound down. So that asset remains as a continuing asset in amongst generations and continues to pay out to future generations. And so you don't have the problem that the RSP does, which is the deemed disposition upon death. And that gives the IPP a significant advantage. In terms of contributions, again, assuming a 30-year time frame, you can contribute to over $1 million over that lifetime. But the other great thing is that the contribution limit continues to increase as you age. So the RSP is fixed at 18% of earned income. The IPP at age 40 for someone aged 40 is 19%, so they're quite similar at that age. But what happens is, as you age, the amount you're allowed to contribute in the individual pension plan tends to increase. So by the time you get to 65, your maximum contribution for the RSP remains at 18%, but for the IPP, it increases to 29%. And that means that the amount of money you're putting into a tax-sheltered environment is significantly higher. So you can potentially accumulate as much as 1.5 million more than an RRSP based on your earnings. And the other thing is there's a calculation, an actuarial calculation based on assumed rate of return. And if you are underfunded, if your underlying investment portfolio does not achieve that return, last I checked, where the assumed rate of return was 7.5%. So let's say your investments perform at 5%, then that extra, the difference between 5% and 7.5% means you're in a deficit for your pension accumulation. And that means you're allowed to invest even more and top it up. And that's a significant benefit. So for high income individuals, the individual pension plan is really beneficial from a tax savings perspective.
I know I'm asking this as an American not familiar with Canadian pension plans, but I'm intrigued by this. So if I understand it correctly, the IPP never dissolves.
If you structure it correctly, it can dissolve. If people aren't planning appropriately, it can dissolve.
Okay.
But if you're focused on intergenerational wealth transfer, you can systematically look at your family structure and say, I have an adult son, and I could register that person, if I'm a doctor, as my administrator in my medical corporation. And as long as they get a T4 slip and they participate in the pension plan, then they become a beneficiary of the pension plan, and the assets transfer there, or some other family member. So in the right circumstances, and for the people who are targeting this strategy, you are correct. There is no wind-up period. This thing can go on for generation after generation after generation.
That's incredible.
So the other thing that you can do, or that's beneficial in the IPP, is if you're overfunded. So if you get to the point where you are well ahead of your target rate that you need, or your target rate of return that's required in order for you to maintain the pension benefit, you can take a contribution holiday and then contribute to your RRSP instead. So it doesn't necessarily have to be an either or. You may potentially get the benefit of both. So that's another huge benefit of the IPP program. And another benefit, we're kind of going on and on about the benefits here, but it's true. The IPP program provides you with a lot of great benefits, but you have the flexibility to choose who your investment manager is. So as opposed to the other pensions, and specifically I'm talking about Medicus and HOOPP, those two are centrally managed by the organizations who administer those plans. So in Medicus's perspective, it's managed by one of the big banks. And with HOOPP, HOOPP is a private equity fund and or pension fund, and they manage the assets themselves. And so you don't really get a say as to who the asset manager is, what the asset mix is, et cetera, et cetera. Whereas with the IPP, just like the RRSP, you can choose who's your investment manager. You can have a say as to what allocation you want, and you can choose to be as aggressive or as conservative as you wish to be in order to maintain the pension benefit.
So theoretically, if you choose to be more on the conservative side and you go into a balanced portfolio, which is traditionally defined as 60% stocks, 40% bonds,
Right.
The likelihood of you getting 7.5% is quite low. You're probably looking more like a 4 to 5% annual rate of return, in which case you can invest even more in the individual pension plan in order to make sure it's properly funded, which for very high income medical professionals or high earning small business owners, it can give them a lot more tax flexibility to pile the money in there and save some taxes. By contrast, if you're limited in terms of your free cash flow and you just want to get enough to fund the pension plan appropriately, assuming a 7.5% rate of return, and you wish to be more aggressive so you can minimize your personal commitment to the pension plan, then you can do so. You can be a bit more aggressive. And should you achieve a significantly higher return and you do develop a surplus, as Alexander mentioned, that gives you the freedom to invest in the RRSP or a tax-free savings account and build your wealth that way as well. The other great thing about the IPP is with respect to probate. Probate. We don't call it probate anymore in Canada, but the process of probate is legitimizing the will and distribution of assets. But this plan doesn't go through probate because you have a designated beneficiary. Whereas in an RRSP, if you pass, or if the second of you and your spouse pass away, it goes into the estate. And that is taxed accordingly, or you designate a beneficiary, but then you got to make sure your estate has enough assets to pay final taxes. So this is another advantage to the individual pension plan.
And you don't even necessarily have to be working at the time. So you could be a retired doctor. So we just recently went through this with one of the attendees from our presentation. You don't necessarily have to be working and earning income from your corporation in order for you to benefit from the IPP program. If you've never set up something like this in the past, you still have the opportunity to set up an IPP and potentially make a significant large lump sum contribution to the IPP as part of the terminal funding option that exists within the IPP program. And so if you have a lot of money that's tied up in your medical corporation that you have not extracted yet, that may be one of the methods that you can remove it on a tax deductible basis, not just tax-free, tax deductible basis. And so that can potentially be another significant value unlocking opportunity for you.
It seems like it would be important that you would be able to pick a money manager, and it sounds like the RSP and the IPP are the only two plans where I could say, for example, I want John and Alex to manage my money here because I feel comfortable with their approach. And is that the case, or is that just me not understanding?
No, that's 100% accurate. Yeah.
If I'm looking at my pensions and I'm in Canada, it would seem to me, well, and it also just is a personal thing with me, I would feel much better if I could have a conversation with my financial manager, my financial advisor, and say, Okay, let's talk about strategy at this particular point in time. And those are the only two plans that would allow me to be active myself with my management. Is that right?
That's absolutely correct, Bill. And the thing that we like to emphasize when we were speaking to both clients and prospective clients is the fact that most management of retirement assets occur at the institutional level. And at an institutional level, there's no creativity, there's no flexibility. They do not employ outside the box thinking. And in an environment such as the one we're going through right now, you need to be flexible. You need to employ outside the box thinking. And that's not available at the institutional level. So that having customization, we believe, gives a big advantage to having someone like MedWealth Financial Services looking after you as opposed to one of the big institutions.
Yeah. And it provides you with another perspective when it comes to asset management, a thoughtful perspective, because, one of the other things that we tend to notice with a lot of medical professionals is that they tend to concentrate their assets in real estate holdings. And while real estate, as we've discussed on other podcast episodes, is a great avenue for accumulating wealth, it should by no means be the exclusive method from which doctors accumulate their retirement assets. And it can also, depending on where they are in their careers and where they are relative to retirement, it may be an impractical solution for them because they may no longer want to be a landlord when they're going into retirement. They don't want to deal with the headaches of having to manage a property, and not to mention the fact that the property laws that exist here, or the tenant and landlord laws that exist here in Canada, are not necessarily favorable to the landlord and can create additional headaches from that perspective as well. And so that's where it benefits them to have somebody like us to speak to and get a second perspective.
Yeah. So this is important to understand, especially with in Canada, a lot of medical professionals that have immigrated to Canada recently from other parts of the world. They don't have robust financial markets like exist in North America. And so their default is simply to buy a house and rent it out, or buy a business property and rent it out. Now, historically, over the last 1 to 2 generations, that has worked out reasonably well as long as you have a good tenant, because as Alexander pointed out, the Landlord-Tenant Act is heavily skewed in favor of the tenant. However, as we all know in North America, with the growing gap between let's say the baby boom generation, the millennials, or even other generations between the millennials and the baby boomers, there's a big gap in terms of financial security. And so it's becoming increasingly difficult for the younger generation to make their payments on their rental properties. And so as a landlord, we're noticing and speaking to real estate agents and to other landlords that people are beginning to have difficulty collecting their rents, and they're getting into situations where they cannot evict a tenant for a year or 2 years, or sometimes longer, depending on how long it takes to go through the court system. So on the one hand, real estate historically has had some benefits in terms of the fact that you're dealing with leveraged money. So you put in $100,000, you can borrow, for sake of discussion, 8 times that, and you're moving $800,000. But by the same token, some of the drawbacks with owning housing as an investment or even business property is the inability to, or the difficulty in managing the property in terms of the tenants. But also then you have the issue of, if you want to maintain market rental rates, you have to spend money on renovation. So it's not as though you just put your money and you forget about it. There's ongoing responsibilities and headaches associated with being a landlord. And the other big headache with real estate is, of course, a lack of liquidity. Liquidity is both a good thing and a bad thing in real estate. It's a good thing because sometimes you can't sell at precisely the wrong moment. For example, when interest rates are rising and it's not a good time to sell, whereas in the stock market, you can do exactly that. You can shoot yourself in the foot by selling at the wrong moment. But the disadvantage, of course, is the fact that if you do really need the money, you can't get it. Whereas in the stock market, even if it is depressed, if you need the money, you can get access to it. So liquidity is a big issue as well, and a lot of people don't think about that.
Yeah, I know we got to wrap up here, Bill, but just to quickly jump in on that, everybody seems to think that the real estate market always goes up, and generally speaking, like the stock market, it does most of the time, but not always. Right now we're looking at a 20% correction in the real estate market in Canada from November. And so, as my dad mentioned, if you want to sell and you need to sell quickly because you need cash flow, you may not be able to. There is inventory sitting on the market that's been out there for months. I was speaking to our real estate agent recently, and she was telling me that she said there's houses that have just been lingering on the market for months because either the demand's not there, people are worried about the uncertainty that's going on in the markets and in the economy, and there's expectations that prices may fall further, and that creates indecision, and that leads to unmotivated or disincentivized buyers. And so that creates an issue, and you're the one who's looking to offload a property. And so you may not be able to cash out when you want or need to.
Generally speaking, as a guideline, I tell people, and of course it'll be individualized in a one-on-one meeting, but if you have, for example, if you live in a large urban area like we do here in the Greater Toronto area, and the average home price is, let's say, between 1.2 and 1.5 million, you should be targeting, from an investment perspective, your financial assets, meaning those deployed in the capital markets like stocks and bonds, should be at least that. And if you want to have a second investment property, now you're adding another million. You should then, after that, continue to build on your financial assets. So at the end of the day, you want to have a balance between capital property. When I say capital property, capital markets property, meaning stocks, bonds, and real property, rather than overloading all to one side or the other.
Yeah, and again, these are general discussions. So if people are listening and are thinking they'd like to have an individual discussion with you all, what is the best way for them to get a hold of you, or maybe to set up a meeting to explore a relationship?
Best way is to visit our website at medwealth.ca. That's med-wealth.ca, or send us an email at info@medwealth.ca.
That's fantastic. The other thing you can do if you're listening to this podcast and you're not a subscriber is become one. It's easy. Hit the follow button. Then when the new episode is dropped, you will be told, you'll be notified, you can give it a listen. I'd also ask that if you like the podcast, please give it a good rating and tell people about it. Word of mouth promotion is a really important and very valuable tool. So until next time, I'm Bill Tucker. On behalf of John and Alex and everybody at MedWealth, thank you for taking the time to listen today. We'll catch you next time.